Hi there. Good afternoon, everyone. As it's now 12:30, I'm pleased to welcome you all back for another episode, I suppose, of one of our final presentations of our month-long event, A Feast of Ideas for your ISA. This week we have turned to the alternative and specialist fund space, and in this uncertain environment, alternatives can often provide a unique source of diversification for a range of investor types. With that in mind, I'm delighted to be joined by Dan Higgins and Olivia MacDonald of Marlowe & Partners, who, following a highly competitive process, rewarded the investment management mandate of the Majedie Investment Trust at the start of this year. I'll hand over to Dan and Olivia in a moment, but just to tick off a few of the formalities, which I'm sure some of our returning listeners are already aware of. You will be muted throughout the presentation, which is expected to last for about 30 or so minutes, and this will leave us with about 15 minutes for some of your questions at the end. So please feel free to send through your questions using the Q&A function on the right-hand side of the screen, and I'll try and group them together and get through as many as we can at the end of the presentation. So without further ado, I'll leave you in the very capable hands of Dan and Olivia, who will be able to take you through how Majedie has evolved over the last few months.
Thanks, Nick. Thank you very much. Hi, everyone. My name is Dan Higgins. I'm the founder of Marlowe & Partners. I'm joined today by Olivia MacDonald. Olivia is one of my senior partners on the investment team. We're really thrilled to be asked to participate in this event. It's an exciting time for us as the new manager of Majedie Investments, and it's an exciting time to be putting capital to work. We see a lot of opportunity at present, and in the next 20 minutes or so, we're going to talk you through our distinctive form of investing and explain why we think Majedie Investments could have a role to play as a component of a long-term portfolio. Maybe just to begin by giving you some background on how we came to be appointed as the new investment manager of Majedie. Majedie Investments has been a listed investment trust since 1985, and its origins as a vehicle for long-term wealth creation go back long before that. And last year, following the sale of the incumbent manager to Liontrust, the board conducted a review with the help of JP Morgan Cazenove, and the board's intention when doing that was to find a new investment manager who could take the company forward and offer something really different and compelling, but all whilst preserving the culture and the history of the company. And essentially that meant leaving equities at the heart of the offering and always serving the interest of shareholders who include a large family interest. So the board, led by Christopher Getley, its chairman, asked JP Morgan to run the process that Nick just alluded to. And what they were looking for in a new manager was a group who could operate to a liquid endowment model, and I'll come on in a second to explain exactly what that means, that really took advantage of the investment trust format and all that it enables. A group that had experience delivering on an inflation plus mandate, had experience of the sector, and so understood the needs and ambitions of shareholders, and could bring new shareholders into the company, onto the register, and thereby narrow the discount to NAV and enable the growth of the company over the medium term. So it was a competitive process. We were delighted to be the board's unanimous selection and then to receive a really strong endorsement at the general meeting at the end of January. We consider it a huge responsibility. We ourselves are shareholders in the company, and we're going to work really hard to repay that vote of confidence. We agreed to what we believe are pretty attractive terms for shareholders, and we could justify doing that because of the size and importance of the mandate to our business, and the fact that the closed-end listed format enables us to invest with real integrity over the years ahead. So the main feature of the agreement between us and the board are a flat fee structure, and it's based on market cap, not on NAV. So we have an incentive to get the discount to narrow. We care about what you care about, which is the performance of the share price. We waived our fee for 6 months to defray costs. We've given Majedie Investments, the company, a 7.5% stake in our company at nil cost, and that shows real alignment of interests, and it also helps to mitigate the costs and fees that are an inevitable part of managing a liquid endowment model further. The formal objective is to beat inflation by 4% annualized over rolling 5-year periods. It's a total return objective, and it includes paying a dividend that we will set at a rate of 3% per annum initially. Why were we selected? Well, above all, I think it is because we can offer an investment proposition that is built to work at a time when more conventional approaches may well be compromised, and because our way of investing and the things in which we invest don't exist anywhere else within the investment trust sector at present. So we can give shareholders access to opportunities that up until now have really only been available to family offices, endowments, a relatively small group of professional investors who form part of a network that we've built up over nearly 3 decades. And the other reason I think that we were the board's choice was that we can bring new shareholders onto the register, and that process has already begun. It explains why the discount has started to narrow. So we have an Oxbridge College, family offices, wealth management firms, wealthy individuals now on the register, and we're now reaching out to the broader investment community with the help of Kepler, which is why we're so grateful to be part of this series of presentations. So what do we actually mean when we talk about a liquid endowment approach? I'll take the endowment bit first. Around 25 years ago, a number of US university endowments pioneered a new way of investing. And in essence, the endowment model, as it's become known, seeks to take advantage of having a really long-term time horizon to focus on fundamental investments, not short-term trading or tactical strategies, and a willingness to embrace alternative return sources rather than just conventional exposure to stocks and bonds in what's become known as the 60-40 model. And we very much share that mindset. I think it was Benjamin Graham, who was Warren Buffett's mentor, who coined the phrase that in the short term, the market is a voting machine. In the long term, it's a weighing machine. We are very much weighing machine investors, and we seek to take advantage of short-termism and volatility that can be induced by macro factors and technical forces and human emotions like fear or greed. So that's the endowment part. But a meaningful and important difference between what we do and what some of the university endowments do is that we don't feel it is necessary to lock money up for multi-year periods in really illiquid areas like venture capital or private equity or real estate or infrastructure in order to generate superior returns. And that's really important for 2 reasons. It's really important from an investment perspective, because we think we can find really attractive investments that do not require multi-year lockup. But it's also really important within the investment trust sector, and especially at a time when the allocator community is increasingly mindful of illiquidity and subjective pricing of certain assets. So everything in our portfolio is marked to market at least quarterly, and it should be realizable within a 24 to 36 month time horizon. So the NAV is a real NAV. Quick word on us. As a firm, we've been around for 10 years. We're independent. We only do one thing, which is manage money according to the strategy we're now going to pursue for Majedie Investments. We manage around £500 million. Up until now, all of our clients have been professional investors, as I say, endowments, pension funds, charities, family offices. We have managed money within the investment trust format before in prior lives. So at my old firm, I used to manage a listed vehicle called the Absolute Return Trust Limited, and we've been investing in investment trusts for our whole careers. So we do understand the needs and the tolerances of shareholders. In terms of the team, we're 12 people, plus 3 very experienced non-executive directors who you can see here on this slide. I used to be the CIO of an $8 billion firm called Fauchier Partners. We manage portfolios of alternative investments for institutions. We had a particular reputation for capital preservation in difficult times. Senior colleagues on the investment team include Rob Elliott, who comes from a legal restructuring background, and Olivia, who's with us today, who was previously at Wellcome Trust and before that at Goldman Sachs. What makes us different? We've just highlighted a few things here. I'll go through them really quickly. First of all, access. Through our network, we can access ideas that you will not find anywhere else. We don't believe there should be any overlap between what you'll find in our portfolio and in other portfolios. That's doubly important for the reasons I just mentioned. At this particular moment in time, the majority of investments that are available, we do not find very interesting or compelling. A generic exposure is unlikely, in our opinion, to get you the outcomes that you want. It is going to be absolutely critical to be able to access the real winners within asset classes, within markets, and to avoid the losers. And that's what we do. This access point, absolutely critical. We've been doing it a long time. We're hungry, we're motivated, we have pedigree in the investment trust sector. We have a proven track record, and it's a real track record, not a back-tested one, in a representative strategy of delivering to an inflation plus mandate. Differentiation, I've already alluded to this, but our hallmark is this idea of finding opportunities that you won't find anywhere else, delivering a complementary return stream. So as far as we're aware, zero crossover with other peers in the flexible sector, which Majedie's just moved into. Risk management, we care deeply about avoiding permanent capital loss. We have sophisticated risk systems. We monitor both external risks, so macro risks that can influence our portfolio, and also internal risks, things that are inherent to the particular investments that we own. Our clients, our investors, should probably expect around 2/3 of the volatility of equity markets. So equities do lie at the core of what we do, but we don't think it needs to be a very bumpy or volatile ride. And risk management is integral to our process. It's not an afterthought. And the same can be said of sustainability. We're not a pure ESG investor. We prefer to engage rather than exclude, but we absolutely include environmental, social, and governance considerations into all of our decisions and our process. And we believe that a responsible investing mindset is not only consistent with delivering good return outcomes, we believe it's pretty essential. So I'm going to pass over to Olivia now to talk you through our investment approach, what we do.
Thanks, Dan. So there's 3 elements to what we do, 3 distinctive fundamental strategies. And to put that in context, we believe that those 3 things together can be more than the sum of each of them in part. And that's for 2 reasons. One is that we think they're complementary in profile to each other and in their nature in terms of what they're doing. But the other is that we think that by having the 3 strings to our bow, we can go where the risk-adjusted reward is the strongest at any point in time. So we run it as a single portfolio. All our investments are ultimately fungible. And so we're not looking for hammers to fit our nails, or maybe that's the wrong way around for the analogy, but you see what I mean. So the 3 elements of what we do and why it is that we do it. Ultimately, it all comes down to where our network is, our unique network, what suits our analytical skills, and where we feel we have the best and most well-honed investment judgment. So there's special investments, external managers, direct investments. I will go on to each of those in turn, but to give you a sense of how big they might be in the portfolio at any point in time, Special investments, long term, we feel that should be around 30% of the portfolio, but it will be driven by opportunity and it will take some time to build up because it is really driven by that opportunity, and these are very particular in their nature. At the moment, we're targeting about 20% in their sort of short to medium term to build up for the Majedie portfolio. External managers, today they'll be just over 60%. Over time, they'll be more in that kind of 50 to 60% range. And that's really because while we're waiting for those great special investments to come along, we want to be fully invested and really make shareholders' money work for them from day one. And then direct investments, these will generally be about 20% of the portfolio, but again, always driven by the opportunity set that we're seeing in front of us. So let's turn first to special investments. These are eclectic returns sourced through our proprietary network. And that network's been built over 20 plus years and ultimately helps us to identify a handful of compelling opportunities each year that we can undertake due diligence on and really form conviction in. So what sorts of things are they? So we put in the second half of the slide, they can be co-investments, special purpose vehicles, thematic funds. To give you an example of some of those things, some of our more recent fundings have been in an activist campaign for a consumer company with a great potential but poor execution. And we've also been pursuing some select opportunities in stressed credits as yields have risen and created stress in the market environment and therefore sell off in certain issues. And in the past, we've also explored areas of sort of unusual opportunities. So, for example, we sourced and seeded an opportunity pursuing opportunities in the listed uranium sector. But ultimately, everything in special investments needs to come and meet our 3 criteria. So it has to come from a trusted source in our network. It must be realizable over 24 to 36 months. And we should see an IRR potential of 20+%. And that's because we feel that the other 2 elements of our portfolio create a very strong hurdle over which this really does need to justify locking up the capital for that little bit longer. But as Dan alluded to, this is not about private markets. This is still in public instruments where the opportunity set is just needs a little bit more patience of capital. So secondly, external managers. So here we're really trying to find the best of breed fundamental investors from around the world, whatever sector, geography or style they might inhabit. It's a focused list, and many of those investment firms are boutique in nature, often owner-operated and very highly aligned, and many are closed to new investment, but we can access it because of our long-standing relationships from this and in prior firms. And maybe again, to give you a few examples of the sorts of folks that we find here, we've got a New York-based value-oriented manager that really looks for catalysts and events to unlock value. We've got a European specialist equities manager based in Stockholm with a very different mentality. We've got a specialist credit manager based in Greenwich, Connecticut that really tries to look for opportunities through the capital structure and work them as things get better or worse for those companies over time. And we've got 2 energy transition specialists that take very different approaches to each other, but are very anchored around that long-term structural opportunity that's taking place and unfolding. So as I hope you can hear, this is really spanning geographies, it's spanning sectors, and it's also spanning asset classes, still predominantly very liquid, but you've got equities, credit, and commodities in them. And thirdly, direct investments. Here we're looking for high quality opportunities in which we believe we can compound shareholder capital for the long term. The reason that we do this is, as Dan alluded to, equities lie at the heart of what we do. We think they're absolutely integral to delivering strong risk-adjusted real returns for shareholders over time. And we always feel that there's a place for direct investing in high value creating companies, provided you buy them at reasonable valuations. And following the market sell-off that we've experienced over the last 18 to 24 months, we feel that we're able to build a really compelling bottom-up portfolio of quite eclectic opportunities at reasonable valuations without a pronounced style bias. And a lot of these stocks are hidden gems or high quality companies that the market, for whatever reason, either doesn't believe are as high quality as they are or doesn't appreciate how good they are. That might be because they're undergoing a transition, or they, in some cases, we find that they're babies who've been thrown out with the bathwater when an area of the market has really been subject to a pronounced sell-off. So hopefully that gives a sense of the sorts of things we do, and I'll pass over to Dan to take forward from here. Dan, you're muted.
Did so well to get this far. So I'll talk briefly about the outlook, the opportunity set as we see it. As I said at the start of the presentation, there's an awful lot to do today. I can think of times when maybe there's been opportunities of greater magnitude, but I really struggle to think of a time when there's been such breadth of opportunity for people like us who turn over a lot of rocks looking for really interesting bottom-up ideas. So I'll talk about the outlook first, and then give you a sense of positioning and where we are in the transition to the new portfolio. I should preface this by saying we are macro aware, but we're not macro led. And we know that we can't predict the future, and we make no attempt to time markets, but we do look for ideas in areas where we believe the probability of future outcomes is not properly reflected in today's prices. And we ensure that there is an appropriate balance across asset classes, regions, sectors, and style factors in the portfolio as a whole. So that said, this is a particularly interesting time for both economies and for markets. And I'll set out our broad working assumptions. So we believe that the three biggest factors that overwhelmed markets last year, that's inflation and the implications it has for interest rates, the war in Ukraine, and China and zero COVID policy, those influences are not going away, but they are abating. And they are abating to the extent that the fundamental merits of the investments that we own can really start to shine through. So it's obviously a huge subject, but we believe that inflation has peaked, but that it will settle at a level that is higher than we've all become used to. So interest rates will be structurally higher than before. The cost of capital for enterprises is higher than before. We have to assume that many of the trends towards globalization are now bound to reverse. The relationship between capital and labor has changed. And very importantly, in the context of our portfolio, there are now alternatives to equities that a combination of rising interest rates and rising risk premia in certain areas means that there are alternatives to putting your money in equities. The risk of recession is obviously elevated. Events in the US banking sector over recent weeks, I think, only add to that sense. So when we are making allocation decisions, our working assumption is that economies are going to slow meaningfully, and that has in particular implications for the earnings prospects of many companies. We think, as a general observation, earnings expectations are still too high. As Olivia mentioned, we think there's a huge opportunity today in corporate credit, and especially in what we describe as stressed corporate credit. So these are senior secured bonds issued by companies. So they're top of the capital structure. They're the most defensive and safe instrument to own if you do find yourself in a recession, that are now at prices we've not seen for years, if not decades, that offer, in our opinion, a total return potential in the low teens or better, with short duration, without interest rate risk. So we think credit's going to be interesting, but we think there may well be problems in the credit system more broadly as bank lending becomes harder to come by. And as I said, the cost of capital goes up, and as a lot of companies face refinancing issues over the months and years ahead. So we're prepared for that. And then final thing I think we all need to take into consideration is the impact of currencies. Now, we always factor the impact of currencies into our fundamental investment decision making, but more broadly, I do not think any of us can assume that the dollar is going to be a one-way, the US dollar is going to be a one-way bet over the months and years ahead. And on that note, our policy by default is to mitigate the impact that non-GBP investments can have on your return, on your NAV in sterling. So with the exception of special investments, our default option is to hedge non-GBP currency risk back into sterling. We will never use moves in currencies as an excuse for not having delivered on the mandate in sterling terms. And investors should think of Majedie Investments as being a sterling asset, which maybe hasn't been so important over recent years. Potentially it could become quite important, and we're pretty pure about that. So moving on to talk about the positioning of the portfolio at present. So the transition is largely completed. We moved very quickly to exit the legacy investments, which themselves were liquid, so it was easy and clean to do that. As of the first day of next month, we will be fully invested. It will feel like our portfolio. This, by the way, shows you the investment portfolio for the time being. At least we do retain a historic stake in Lion Trust. We immediately have built up our exposure to our direct investments, so they're approaching 20% of the portfolio today. That's 12 stocks, a really eclectic mix of some value, some growth situations. To give you a sense, our analysts currently project around 30% upside to base case price targets, despite our pretty conservative assumptions about the operating environment. So we really do feel that this is a great time to be an active stock picker, and we're almost spoilt for choice in terms of ideas that meet our criteria at present. 70% of the portfolio today is allocated to external managers. That's because we wanted to be fully invested, but as Olivia said, over time that number is likely to come down initially to 60% as the allocation to special investments goes up. In terms of the sorts of managers that feature in the portfolio today, again, Olivia gave a flavour, but we've got a mid-cap biotech specialist, we have a software specialist, we have a Scandinavian equity specialist, a CEO-led turnaround specialist, a China specialist, and a value catalyst manager. All of those managers are operating within the equities area, and again, giving these really differentiated return streams in niche areas. And then approximately more than 25%, approaching 30% of the portfolio is allocated to the specialist credit area that I talked about. Some of the best practitioners in the business, and we've known many of these people for years and years and years, they are telling us these are the best risk-adjusted return opportunities that they've seen in their investing lifetime in some cases. And so we're feeling very positive about that. There are alternatives to equities. And then finally, in special investments, we've immediately got access to a handful of our existing ideas that are still open. So those straight away amount to 10% of the portfolio. We hope to get that number up to 20% by year end in due course. The target is 30, and that will largely be funded through the external manager allocation. I should say on that note that we're keeping liquidity good in order to give us that flexibility to rotate capital into the best areas. Quick word on reporting. We're very transparent. We want to communicate to our shareholders what we're doing, so we're going to produce a monthly fact sheet. The first one that we will be producing, or that will reflect the new strategy, I should say, will be out early next month. We are going to produce 2 NAV estimates per month. So as well as a mid-month estimate, which will come out a week or 10 days after the mid-month point, we will also publish a end-of-month NAV estimate shortly after month end, and the NAV estimate for the prior month will be released at the same time as the mid-month estimate. So investors should have a pretty good sense at any given point in time of where the NAV is. And as I said, everything in our portfolio is priced pretty regularly. So there should be no issues or question marks around subjective pricing or kind of lagged effects of market conditions that don't feed through into the NAV. Then finally, we'll just leave you with this chart as a summary before we're very happy to take some questions. The critical points that I hope have come across: Majedie Investments has moved to a liquid endowment model. We think the timing for that could be terrific because of the opportunity set, but also because the world has changed. And I do think it's important that all of us, and we're certainly reframing our assumptions and expectations, all of us recognizes that the world has just changed. The next 10 years, 20 years is unlikely to look like the last 10 or 20. And that's why it's going to be so critical to access differentiated fundamental returns sources. And that's all we do. That's what we specialize in doing. We're experienced at doing it. We're aligned with the shareholders in Majedie Investments. We're really enthused and excited about this project and the potential to deliver on performance and grow the trust over time. And this is a great time to be an active manager. There's so many opportunities today, and our job now is to go out and find them and capitalize on them for shareholders in Majedie. So thank you for listening, and be delighted to take any questions.
Thank you very much, Dan and Olivia there. That was a very insightful presentation, I guess, and a good overview of what Majedie has to offer investors moving forward. We've had a few questions coming through, which have been good. A few around discount premium management, I suppose, of the trust. I think you touched on briefly new shareholders' interest at the beginning of the presentation. But what's the sort of feedback been thus far on new investor interest coming into the portfolio and into the trust?
So we're really encouraged. We see it as a kind of three-part process, I think. The first has been to communicate with groups who we knew were interested if we ever were to manage money within the investment trust format. It's been an ambition of ours to do so really since we started our firm 10 years ago. And certain groups have said to us, if you ever do it, we would love to support you in that project. So we've made them aware. They already know us well. And some of those are already on the shareholder register. As I mentioned, I think the most conspicuous or important of those is an Oxford College, which I think really is a tremendous validation of the liquid endowment approach. And one of the things we're encouraged by is that we know most of these groups who are on the register now could be much larger shareholders in due course. They can, and we hope will, add over time. The second part of the process has been to talk to members of the wealth management community in particular. We're finding that, again, our message is resonating well, that there is a gap in the market for what we do. And it's been really encouraging to see some of those groups now come onto the register. I would say the same thing. They've very often started relatively small relative to what we know they're capable of doing. And I think as we show that we can deliver, and especially since the date of handover, we'd like and expect to see some of those groups add. And then the third, relationships and get the message out there to members of the individual investor community. So this event is a critical part of that. And also to start to cultivate relationships with larger institutional investors who perhaps are too large to put for what we do to make a real difference for them today. But we do know that in the years ahead, if
I think Dan may be having some technical issues there. Olivia, you're available? Or is Dan's back?
I'm back, sorry.
Okay, Dan's back. That's fine. That's fine. I think we lost you on your final point there.
I said, yeah, we're really happy to be building kind of relationships for the long term. and we're on track. And yeah, obviously it's nice for potential investors at this point in time to still be able to buy into what we're doing at a discount to NAV, and we are really incentivized to get that discount to narrow further.
Perfect. That's it. We did miss a crucial point there, so that's good. I suppose that we've had a couple of questions about the target. Obviously, CPI plus 4%. Obviously, that's going to be challenging in the current environment. Where do you see that? How do you see yourself achieving that, I suppose, over the medium term, longer term as well?
So obviously, inflation, wherever you look in the world, has spiked to a level that very few of us could have anticipated a couple of years ago. And we're very confident that over the medium term, we can deliver a return that beats inflation wherever inflation happens to settle. I think the one caveat to that would be if inflation remains at 9 or 10% in the UK, I think we would be in capital preservation mode rather than whatever has happened in order for inflation not to come somewhat under control. I think would mean we would be in capital preservation mode rather than return generating mode. My personal view is that inflation will almost inevitably come down. What we don't know is what that means for the economy and earnings for companies in particular. So I think there are two approaches to trying to deliver inflation beating returns at a time when inflation and therefore interest rates are structurally higher. The first is to invest in instruments that will theoretically do very well if inflation is high. But if you're wrong about that, or if inflation is not as high as implied in the prices you have to pay to own those investments, you will lose money in real and absolute terms. That's other people may be capable of doing that. That is not our skill set to invest in asset classes that are predicated on a certain macro view coming to pass. Our response is to invest in eclectic bottom-up investments that are uncorrelated to one another, and that's a feature of our portfolios. The cross-correlation between the investments in our portfolios are very low, any one of which is capable of beating inflation by a significant margin. So Olivia and I both alluded to the opportunity in stressed credit at the moment. We think through a combination of pull to par, so bonds that were trading at par now might be trading at 80 cents in the dollar, and carry, many of the bonds that we're looking to invest in through external managers primarily, have a current yield of 9 or 10%. It is possible to deliver annualized returns of 12, 13, 14%. Now, I don't know whether inflation will finally settle at 5% or 4% or 3%, but I know that that will be an inflation beating return if we're right. So our preference is to put together an eclectic group of investments, all of which are capable of beating inflation by a lot, rather than investing in things that that will only work if inflation is a certain level and not another. And the final thing I would say is we really mean it when we say we would like to be judged over rolling 5-year periods. There will be shorter term periods in which we do not beat inflation. That's reality.
Okay, great. I think there was a question as well on back testing, but I think you alluded to it earlier on in the presentation about the track record of Marlowe & Partners managing these kinds of strategies, and I would suggest having a quick look at my last note, the updated note on the KTR website for that. There's a bit of explanation around the past performance there. I would say we've got another question, well, a couple of questions regarding the focus on equities, I suppose, and how has that led the portfolio to the geographical exposures within the portfolio? I suppose, are there any specific areas that you are more interested in than others? Obviously, you take a bottom-up approach, and the portfolio is a reflection of that. But where are you seeing many opportunities at the moment, I guess?
Olivia, do you want to take that one?
Sure. So as you said, Nick, we are very bottom up in how we approach things. And ultimately, particularly through the external managers, we want to find managers who we think can grow our investment for multiple years. So we're not looking for kind of a quick trade. Having said that, we do feel that there are areas of the equity markets that have been that offer particular opportunity at the moment, many of which have kind of fallen quite significantly. And we will look, if we feel that there's also structural opportunity in those markets, we will look to increase our exposure. So two obvious areas apologies, to which we added last year are small and mid-cap biotech, which we increased our investment in the summer last year, which was so far, touch wood, good timing, through quite a flexible manager. So one that we think is quite pragmatic about calibrating valuation, as well as assessing scientific and commercial possibility. And the other is around enterprise software, where we feel as though, yes, the market got overexcited and valuations became overstretched, particularly for non-profitable companies, but where we really do feel that there are some mission critical operators out there that are now trading at really attractive valuations, and we think we can generate very good returns off them going forward. And I think the other area, which we express through both our external managers and our direct investments, and actually the enterprise SaaS, we also have got some direct investments in too, would be around energy transition, which I alluded to earlier. We see that as a long-term structural opportunity, but we don't think it's linear. We think that there will be bumps in the road. There will be moments in time that the market becomes over-exuberant around the progress that has been made and over pessimistic around the progress that has been made. We think that a flexible manager can really navigate that very well if they've got a good fundamental understanding of the direction of travel and the regulatory regimes around that. So maybe that gives a sense of three particular areas where we have been adding money over the last sort of 12 months or so. But really at its core, we're really trying to find excellent managers with skill sets that fit against a perennial opportunity set, would be how I would frame it.
Okay, brilliant. I've had a question here about the high interest rate inflationary environment. On your, I suppose, your views, I guess, around that, where do you think it will potentially settle? And do you think the sort of interest rate level at the moment is correct, given the environment, I suppose?
So I'll share my current working assumptions. And the answer I think Olivia and I can give with some confidence is how we are factoring this into our own decision making. I see the question on my screen around discount rates and how we factor that into our decision making. So we'll answer that with I hope some clarity. I do think that it's just become quite a bit more complex in recent weeks, that it's been a surprise to many of us that interest rates in the US in particular have gone up by nearly 5%. And with the exception of the LDI incident here in the UK and certain pockets, kind of speculative pockets like crypto, there haven't been any bodies float to the surface. Well, we've just had some bodies float to the surface in the last couple of weeks in the form of banks who are particularly exposed to owning longer duration assets that mark to market have lost money, and then the knock-on effect that confidence has on depositor bases. And I think the Federal Reserve, as the kind of developed world's central bank, now faces a bit of a dilemma, which is, do they keep using the Fed funds rate as the main tool to keep inflation under control? But in doing so, do they risk creating a systemic problem in other banks? So we'll have to wait and see. For what it's worth, we have no direct exposure to banks. We have minimal exposure to banks through our external managers, but everyone is aware that markets are very interconnected, and some of the people who own the things you do own may have exposure to those things, so there are always second order effects. The thing I think is going to be really interesting is to see whether actually the recent events in the banking sector do some of the Fed's job for it. And so I think for us, the first thought is that bank credit, the credit that is extended by banks into the real economy, is going to be severely curtailed as a result of what's been happening. And that, I think, means that one should really prize investments that you think can grow their earnings and cash flows kind of regardless of the economic environment. And it also means that you've got to be very careful about any strategy that involves kind of lending. Now, that creates a ton of opportunity for the sorts of specialist credit investments and managers that we would make. The cost of capital is going to be higher. That means, as discriminating providers of capital, they can demand a higher return to compensate them for extending risk. So, got to be careful. Will definitely have implications for the real economy, but we think it creates opportunity. And then I'll allow Olivia to talk about how we factor discount rates or interest rates into our direct investments opportunities. But I would say that we don't use balance sheet leverage. We don't invest in some of the strategies that we alluded to earlier, like private equity, venture capital, some of the areas that I think have been most dependent on leverage, low interest rates, abundant liquidity. And so I think we should be relatively well placed to take advantage in that respect. Olivia, is it worth just saying a word on how we factor discount rates into our own decision making on the direct investment side?
Sure. So I think there's two schools of thought as interest rates change. One is that you should be constantly adjusting your discount rate, and the other is that you should constantly ask for a different margin of safety using the same discount rate. And we generally fall in the second camp just because I think it is easier. It makes things more explicit. What are you willing to bet on and what are you not willing to do so on? And so the way that we factor it in is we keep our discount rates broadly constant when we're looking at these companies in which we invest directly. But as Dan alluded to, they tend to be relatively lowly levered in terms of their balance sheets. And what we are very conscious of at the moment is that anything where we're waiting for longer for free cash flow to be generated, we're going to need a higher margin of safety to be willing to take that on. Because the world has become more uncertain with respect to funding and with respect to the market's appetite for that funding. And so really what we try and do is we will try and use a sort of consistent valuation framework so we can appraise a range of opportunities, but we will try and square that away with as many approaches to valuation as we can to really get to the nub of what is this asset worth, how long might it take the market to work that out, and are we willing to wear the volatility that might come along the way. And I think, as Dan alluded to earlier, the really exciting thing for us on the direct side at the moment is that we're seeing very high margin of safety using those valuation assumptions that we have kind of broadly held constant. We would expect that to be the case because we want a higher margin of safety and the market's telling you it does too. But we're seeing that margin of safety appear across the piece. So we're seeing it in longer duration opportunities and shorter duration opportunities. We're seeing it in structural growth areas and in more cyclical areas. And so it's giving us a really, I think, as a stock picker, a really exciting time to be sitting around the table with colleagues and debating the relative merits of these different opportunities, whether we're expressing them through the direct side or the manager side, with valuation really sitting very much at the heart of that discussion.
Okay, brilliant. Well, I'm cognizant of time at the moment. I think we've slightly overrun anyway, so I think that's probably a good place to wrap things up. So thank you both. On behalf of Dan and Olivia, I guess, and the rest of the Majedie investment team, thank you all for your questions today. For the rest of the week, we have Greencoat UK Wind and MB Private Equity Partners joining us, and we look forward to hosting you for the rest of the event. So please do look at the website and sign up if you're able to do so. Dan and Olivia, thank you again. Great presentation, and thank you for answering all the questions that we've had in today. And with that, have a lovely afternoon, and thank you very much again. Thank you.
Thanks for having us.
Thank you.